Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, May 17th, 4:34 p.m. Eastern Time, coming to you from the financial capital of the world, St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Change to the state of the market. We had, from a technical standpoint, we had some of the rules that we follow to signal a market bottom happen, most notably an up day on major indexes with greater volume than the prior day, and that we certainly had that on the S&P and on the NASDAQ. However, not a lot of, in fact, really no setups in growth leaders. So I'm keeping the state at market correction, even though we've had a day 4 follow through day. We're also still stuck below the 21-day exponential moving average. So basically what we have is a bear market bounce with the required volume to show a follow through day, but I'm not buying it yet at this point. You can see over here on the trend gauge, we're still red across the board. Leaderships showing leadership stocks, market leaders, growth leaders showing bearish / downtrend. Short term, our 21-day exponential moving average still showing downtrend, although the sub arrow is green and pointing positive, as we actually had the 21-day moving average challenged by the mid cap index today, and also by the growth portion of the, actually no, just the overall S&P 600 small cap. The S&P 600 small cap is not as frequently used as the broader Russell 2000 small cap index, but I believe it did close a fraction above the 21 today. I'm going to go through a bunch of indexes and see where we stand relative to the moving averages, and you'll see why I'm still at this point having a hard time buying that we're in an uptrend, because really we're not in an uptrend. Medium term, still firmly below the 50-day moving average across the 5 indexes. Long term, below the 200-day moving averages. A lot of work to do, a lot of overhead supply levels to churn through, but we certainly did see some positives off of the bottom over the past 4 days, got through a key resistance level, tested it and held it. And if you're looking for green shoots in a market, they're there. But there are still a lot of boxes in the plus column that need to be checked in the days and weeks going forward. So as I said, what just happened, day 4 follow through day, but a lack of leadership. So the numbers are nice and green. G6 led up 3.2%, S&P up 2%, NASDAQ up 2.6%, Dow up 1.3%, mid-caps up 3%, Russell up 3.2%, diversified global 60/40 stock and bond index up 1%, GROTECTION up 0.31%. As we change the type of market that we're in, and we go from bear market downtrend to early stages of a bull market, we're going to lag. That's just the way it is because we have a heavy cash position. However, we still have an 8.4% lead over the S&P 500 year to date. And at this point, we will just look for the signals that we use to finance our risk, meaning as we make positive steps in the market, we'll dip a few more toes in the water, and if what we own turns around and gets worse, we'll cut our losses short. So let's get into this very quickly, but first let's get into the team here at Revere. Trend following is what we do. Common sense approach to the market, no opinions, just fact-based. When the market's trending higher, we get involved. When the market is sideways, we tap the brakes a little bit. When the market is in a downtrend, we apply the brakes full force, get the heck out of the way. That's pretty much where we've been over the last 3-4 weeks. And if you're interested in an approach like this, give us a shout. It's the you can sleep at night approach to the markets. Email any of us, Dan, Tim, Hunter, Mural, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's start off with the S&P 500 here, and let's bring up the tail of the tape. So, starting at the top with the tail of the tape, Correction with a day 4 follow-through day. Headwinds still persist. That's strong U.S. dollar, although the dollar was down today. That certainly helped stocks. Tim alluded to that last week. Still fighting inflation, not really winning that battle either. Fed taper, balance sheet reduction, rising interest rates, Russia, Ukraine. Sentiment is there to signal a higher market move. Let's see this. So put call was at 101. It spiked to 1.7 at one point last week. VIX dropping was in the high 30s, down to 25.11, down 5% today. Fear and greed index up 3 to a 15. That's still at extreme fear. So here's what I want to highlight. Our bull case, S&P 500 initiate a rally and reclaim the 21. So we've got the rally with the follow-through day, but we're still below the 21-day moving average, which again is, I'm not about to call this an uptrend. Bear case, rally failure and break of the key moving averages. This was confirmed on 422, 5.5, and 5.9 as any rallies were sold. So really we're looking for a change in character in the market that we don't have yet at this point. News, retail sales before the bell up 0.9% versus 1% expected. March revised up from 0.5% to 1.4%. So this is saying that the consumer is still spending despite the fact that GDP came in negative for the first quarter. But these are April retail sales. But these stats get revised all the time. They're adjusted for inventory. They're adjusted for seasonality. You don't really even know what you can trust, but what you can trust is the reaction to them. And the reaction to Jerome Powell had an interview at 2 o'clock today. When he started talking, he was stressing demand destruction and price stability. Those are the things that he is committed to getting and keeping in the markets, both in the economy and in the stock market. And while he was talking at first, we started selling off. But while we were selling off, all we did is test a level that was breached intraday, reclaimed. It was breached again and reclaimed. And that shows strength in the market. So coming into today, we're watching our prior support level 39.60 and this resistance level 40.50 to 40.70. So overnight, we had a strong gap up. We opened up 1.6% above this 40.50 level. We opened at 40.70, in fact, right at the top of the range. From there, we sold off. It looked like that this gap up was just going to be an utter failure. Let's go to the S&P 500. You can see here, here's our fourth day up off the bottom. Prior 2 days, we ran into the declining ADMA. So another small change in character is that we got above the ADMA, came back and tested it intraday. It held, and we closed near the high of the day. You can see we're still 1.5% below the 21-day exponential moving average, and also running into a little bit of resistance here coming up in the 4100 to 4120 area. But let's look at the intraday here, and you'll see what I'm talking about. So here's the gap up. Immediately we sell off. That was the high of the day until noontime. We came down, broke back below this 40.50 to 40.70 area, all the way down to 40.34 into yesterday's range. But we put in a bottom there and rallied back up, back above the 40.50, stopped at the top of that range at 40.67, consolidated for a little while, and then broke out of it all the way up to 40.78. Now, here's where Jerome Powell started his interview around 2:05, and this is where volatility picked up. So initially, we tried to break out, but then we sold down, broke back below the 40.70, 40.50 range, down to 40.43. But the lows of the day held. All we did is touch the highs again of the prior day and approach the highs of the day before that and bounced. This is what you want to see when you're trying to establish new levels higher in the market. So intraday, multiple undercut and reclaim of this 40.50 to 40.70 range that we've been talking about. 2 attempts to break below it failed. We closed back above it and closed near the high of the day at 40.89. So this is the good news in the market. I'll talk about what we did intraday momentarily. So let's get back to the indexes. There's your S&P 500 with the follow through day. Let's look at the Nasdaq 100. This was up 2.6% today. Still a lack of relative strength, although it did show some relative strength versus the S&P today, but same setup with the undercut 4 days ago. That was day one. Day two ran into the declining ADMA, now got back above the ADMA, busted through some intraday support ranges around this 300 to 302 area, but survived it and closed near the high of the day. So that's more good news. Let's go to the Dow Jones Industrial Average. This was a laggard today because of a poor reaction to Walmart's earnings report. But same situation, you can see the undercut 4 days ago, 3 straight up days, still below the 21 EMA, did reclaim the ADMA, and also back above this 32 500 area that has been acting as a little bit of resistance. So one closed back above that. And all of these indexes, today's lows are going to be crucial. That's what we're certainly looking to hold. Here's a relative strength leading, the relative strength leading index. Again, you got the undercut, day 4 off the low, closed just shy of the 21-day exponential moving average. This is the key average that we move for short term, that we use for short term. We want to see all the indexes get back above this. Not only the indexes, but the growth component of those indexes also. We don't want to be led by a bunch of staples type stocks, which are really just a safe place to park money and not anything that's going to outperform the broad market across any long term. So that's IWM. That's mid caps. Here's IWM. Same thing. So the markets are at least consistent in that they all put in a low 4 days ago. They all bounced. This was their 4th day up. They all closed at the top of the range across the board. And they chewed through some resistance, in this case, this 180 level area for IWM. So certainly some positives there. Let's get back to the tail of the tape here. I talked about what we were watching. I talked about the intraday behavior in the S&P 500. The overnight range 4,004 to 4086. We opened at 4070. Something I've always tracked, but I'm going to add it to the tail of the tape, is this opening 30-minute range. Over 60% of the time, the high and or the low of the opening 30-minute range contain the range for the full intraday. Sometimes it breaks both of them. Today was a case where both of them got broken. This is the red X that indicates, but this tells you really who's in control at the time, and the in control shifted between the bulls and the bears today, but the bulls certainly had the ball at the end of the day. So some notes. 6 straight down weeks in the Nasdaq and the S&P 500 and 7 in the Dow Jones were certainly due for a bounce, and that also factors into the fact that I'm not going whole hog in the fact that, hey, this correction's over. You're going to have to show me. And a couple of notes and 2 stocks that certainly were of interest today. AMD got an upgrade. We've been talking about how the SOX has been showing subtle relative strength over the last 3 weeks, while the NASDAQ 100 hasn't. And that's certainly a good news. We all know that there's a semiconductor shortage. So the demand is there, the supply is lacking, but the price support hasn't been there. These have been trending lower back since the end of the year, and mostly because the PE ratios are on the high side relative to what investors, big pension funds, hedge funds, mutual funds are comfortable with. They have to park their money somewhere in tech. If you're a large cap fund, you're really, don't let anybody kid you, you're mostly a closet indexer, and over 25% of the index is technology. So you're going to be parking your money somewhere. Usually it's in low PE stocks. And some of the semiconductor valuations have really come down to where they're attractive. We're going to talk about a couple of those in a little bit. AMD, one of them. Let's show this chart. AMD had a great earnings report 2 weeks ago, but the market just wasn't ready to accept it. It sold off for a little while, not in any volume equal to the 120% volume that we had on the 9% up day after earnings, and really not a lot of support was being shown. But again, look at the relative strength under the hood. If you just look at the price, you think it's selling off, but while the price is selling off, the relative strength really didn't come down that much, and then it made a new relative strength high and a new price high today, breaking through this key 100 area that acted as support back here, going all the way back to August of last year. This 100 level was in play in August, in September. It bounced there at the end of January. It bounced there March. Finally broke through while we were correcting at the beginning of April, failed at that level on earnings day, pulled back, made it above earnings level today, and the 50-day moving average and that key 100 level. So this is a very key, one of the keys to the success of the market going forward. I think that this will play a big role in it. If it fails here, fails at the 50-day, fails at the 100 level, I wouldn't expect other semiconductors to fare any better. NVIDIA, I also mentioned last week, 100 for AMD and 200 for NVIDIA. NVIDIA is really not participating yet. This chart still showing weakness and also not showing the relative strength that AMD and the overall SOX is. So definitely something that we're aware of. But there are at least two semiconductors that certainly have our interest. The first one is ON Semi, reclaim the 200, the 21, and the 50-day moving average all in the last 3 days, and AVGO, Broadcom. And both of these have PEs under 20, so this is another reason why these are attracting our attention. AVGO Broadcom making a new relative strength high well before price. Look at where relative strength was back here, where the price was 678. We're back above the 50-day moving average and at 608 today, and relative strength is quite a bit higher than that. So these lower cap, there's lower PE tech stocks are a place where money can be parked. Two other ones are HPQ, which has a 9 PE, and HPE, which has an 8 PE, and you'll note the relative strength on these stocks over the last 5 weeks. Don't know if that'll continue if the market shifts back into more growth. I would expect that it wouldn't, but today at least, these did participate while staple stocks didn't, which shows where money has been parked. Note the big relative strength on the consumer staples ETF, but it was down today. So if you're getting a little more aggressive, you're going to take money out of where you've been parking it and put it into some places that you think you can get a little better return. Note the price action has not been that good on XLP, and you're sitting around the 50-day moving average. But relative to the S&P 500, this chart looks fantastic. But stocks that make up a big percentage of the XLP today, like Procter & Gamble, Coke, Pepsi, Costco, and Walmart, those were all down on the day. Again, this signifies a little bit more of a risk-on posture. So where are we now? We talked about the ranges, the notes that we had where we closed. What sectors led today? Chemical stocks, we're seeing a lot of money flowing into these. We've been talking a couple of them and some that are in the Fab 40. OLN, you can see making a higher high. And there's a couple more that we'll talk about as the week progresses. Albemarle, and these are EV related stocks too, but that's looking good. The lithium stocks, these are also in the chemical arena, LTHM, so showing some relative strength there also.